right? What we are going to do is we are going to start with the revision of capital gains. The revision of capital gains in my book is in 3 chapters. You have capital gains, business reorganization, and transaction with owners. Now, the chapter of capital gains in my book comes and says that any kind of transfer of capital asset which is happening in the previous year will be taxable under the head capital gains. Certain words to remember: capital asset means any asset except for stock in trade, except for any movable personal effects, except items like BA pass DJ, bullions, archaeological collections, paintings, any work of art, shares, scriptures, drawings, jewelry. All these items, even though they are movable personal effects, are taxable under capital gains. Then third item which I am not taxing it is rural agriculture land. Why am I not taxing rural agriculture land, Rahul? Because it is agriculture income, and exempt from taxes. How do you decide something is rural agriculture land, Rahul? You come and check whether it is not an urban agriculture land. How do you decide something is urban agriculture land? Check if the property is within the municipality. If the property is within the municipality, the population should not be more than 10,000. If the land is within 2 kilometers of the municipality, again population should not be more than 10,000. If the land is within 2 kilometers to 6 kilometers, population should not be more than 1 lakh. And if the property is anywhere beyond 6 kilometers up to 8 kilometers, population should not be more than 10 lakhs. Any property above 8 kilometers will always be considered as rural. Beyond that, the provisions come and say that if you have any special kind of assets like 6.5% bonds, 7% bonds, national defense bonds, any kind of special bearer bonds, all these are exempt from taxes. Any interest coming from it is also exempt from taxes. And then we came and discussed that if you are a foreign institutional investor, income tax has come and clarified that any securities you hold, even if it is your nature of business, it will always be treated as capital gains, so that I can give you the lower tax rate benefit. This is what the provisions are. Keep in mind that the assets which are not liable for capital gains are personal movable effects like cars, mobile phones. All these are not taxable if it is a personal asset. Only BA pass DJ is covered. Then you have something called as classifying your capital assets. Income tax has said you classify your assets into 3 buckets: 12 months, 24 months, 36 months. 12 months comprises of listed securities except for market linked debentures and specified mutual funds, which is an amendment for current year. Then units of equity oriented funds, units of UTI, and zero coupon bonds. You need to have a period of holding of 12 months or lesser to be short term. Anything more than 12 months is long term. Then if you have a land and building or any unlisted securities, then the period of holding will be 24 months for short term, and anything more than 24 months will be long term. Any other asset which you have will be treated as 36 months for short term, and more than 36 months for long term. Definitions are not important, so we are going to skip it through. Moving on to transfer. Income tax comes and says something is regarded as transfer if there is a sale, exchange, extinguishment, relinquishment, conversion, maturity, compulsory acquisitions, possession of properties where there is a partial consideration or a part performance, and any kind of transaction which has the effect of enjoyment given to you on an asset. These are all transactions regarded as transfer. Income tax comes and says transfers are generally taxable in the year in which the transfer takes place, meaning the year in which the agreement is executed. And not the agreement to decide to sell. Transfer happens in the year in which the agreement is executed. Ownership is transferred. Then we have the case law. The case law came and said the same thing. Where the assessee has entered into an agreement to sell and subsequently ratified the same by way of compromise deed, it cannot be said that the transfer took place on the date of agreement to sell, but will happen in the date on which the assessee's right in the property is extinguished and the new owner has come into existence. When we read transfer, we also need to read those kind of transactions which are not regarded as transfer. Income tax says some items are not regarded as transfer. The items which I told you very important from exam perspective are or gift. Any kind of gift given to someone will not be regarded as transfer. If you give someone a gift, the cost of acquisition for the new owner will be cost to the previous owner. Period of holding of new owner will be period of holding of previous owner. Indexation of the new owner will start from indexation of very good date of transfer, unless and until you opt for Manjulasha case. In Manjulasha case, you can go to previous owner, otherwise you have to do current owner. Next items, I came and said, if you have any partition of HUF, if you have any ESOPs happening from employees, or if you have any kind of will or inheritance happening, then also transaction is not regarded as transfer. Next, we discussed that if you transfer any assets between your holding company to wholly owned subsidiaries, meaning the subsidiaries in which there is 100% shares, if will not be regarded as transfer, provided the subsidiary is an Indian company. Vice versa also works. If the subsidiary gives something to the holding company, then also it is not regarded as transfer, as long as the holding company is an Indian company. In simple words, the person receiving the asset should be an Indian company. Rules come and say, if you do not want the transaction to be regarded as transfer, please ensure that the assets which you get are not sold for a period of 8 years. Or you should not extinguish your rights in the assets in the company for a period of 8 years. You should not extinguish your rights in the company in the year for a period of 8 years. If you violate these conditions, the year of taxability will be the original year of transfer. Is what the condition says. Again, if a transfer like this is happening, cost of acquisition for new owner will become cost to previous owner. Period of holding of new owner will be period of holding of previous owner. Indexation of new owner will be from the date of transfer. Then you had some assets which are, then you have some transactions which are not regarded as transfer, not so relevant from exam perspective. There are items like transfer of capital asset by banking to banking institution, predecessor cooperative bank to successor cooperative bank, predecessor cooperative bank in a reorganization model, original fund to resulting fund, any kind of shares of unit in original fund to relocation happening in a resulting fund. All these are transactions. Then you have any kind of transfer of capital asset between India Infrastructure Company to notified institutions, any kind of transfer of capital asset by a public sector company to other public sector company. Don't read all this from exam perspective. Look at the transaction. If the transaction is a very weird transaction, exempt it off. Next, any kind of transfer of foreign currency bonds or GDR, rupee denominated bonds of Indian company by one NR to another NR, outside India. Indian assets, foreign people are transferring, will not be regarded as transfer. Next, any kind of transfer of foreign currency bonds, rupee denominated bonds, derivative bonds, other specified securities happening in IFSC unit, again not taxable. Then transfer of government securities, redemption of sovereign gold bonds, any kind of work of arts and all given to museums and all are not taxable. Amendment for current year, if you have conversion of gold into electronic gold receipt, or if you convert gold into gold receipts or gold receipts into gold, both are not taxable. All these are assets. Period of holding of the new asset will become period of holding of old asset. Cost of acquisition of new asset will become cost of acquisition of old asset. Indexation will start from original asset. It will start from original asset itself, because assessee is still the same. Notice the yellow carefully. It will start from the original asset because the assessee is still the same. Then we had something called as any kind of transfer happening in a reverse mortgage scenario. We discussed in a reverse mortgage scenario, the transfer of the asset is not taxable. The money given to the senior citizen is also not taxable. The only thing which is taxable is the final asset sales by the bank in case of default. That also is taxable in the hands of the senior citizen and not in the hands of the bank. Last we came and said, if you are going to do any consolidating scheme where you are merging two or more mutual funds together, if the original mutual funds and the revised mutual funds are the same nature, then no taxability. If they change nature, then it is taxable. Pause and look at the example, you will find it out yourself. Yes, moving on. Your amendment for current year, it says transfer by a public sector company the interest in a joint venture in exchange for getting the shares of another company incorporated outside India by a foreign state. Yes, all these are very specific scenarios. You can ignore it off. You can ignore it off. Now that you have understood what is capital asset and transfer, you need to prepare the mode of computation. You need to prepare the mode of computation. Capital gains computation format is starting from full value of consideration, reduce cost of transfer. You will arrive at net consideration. In this, you will reduce cost of acquisition or index cost of acquisition. If it is long-term asset, then you will reduce cost of improvement or indexed cost of improvement in order to arrive at your capital gains. Let's look at these items one by one. First item is full value of consideration. Income tax says if you have any full value of consideration, that means it is the actual consideration which you received. It means that is the actual consideration which you received. What if I have an asset on which there is no full value of consideration? I will assume the asset to be fair market value. If the full value of consideration is not determinable, the full value of consideration will be the fair market value. Rahul, I have paid STT on my considerations. Will it be allowed or ignored? It will be ignored. It will be ignored for the purpose of computations. It will be ignored for the purpose of computation because you are eligible for the benefit of 112A or 111A. You are eligible for the benefit of 112A or 111A. Yes, with me? Next I'm coming and saying, Rahul, if you have any immovable property, and if you're planning to transfer the immovable property at a consideration lesser than stamp duty value, if you're planning to transfer it at a consideration lesser than stamp duty value, then the stamp duty value will be deemed to be the full value of consideration. However, this provision will not apply in case the stamp duty value is within 110% of consideration. In exam, if they give you two stamp duty values, you need to take the stamp duty value on the date of transfer. You can also take the stamp duty value on the date of agreement if you satisfy two conditions. Condition number 1, you should receive advance. Condition number 2, advance should be received by permissible modes. Very good. Advance should be received by permissible modes. Rahul, I am not happy with the stamp duty value. I can go and approach valuation officer. If I approach a valuation officer and valuation officer gives me a lower value, I will take lower value. Valuation officer gives higher value. I will assume the value to be stamp duty value. Assume the value to be stamp duty value. In simple words, it is stamp duty value or valuation officer, whichever is lower. Then I had the condition where I came and said it is 50 CA, where 50 CA comes and says if you have transferred any unquoted shares, unquoted shares should be transferred minimum at fair market value. If you don't transfer it at fair market value will be assumed to be the full value of consideration. Yes or no? Yes, this was a definition for full value of consideration. Next comes cost of transfer. Income tax says cost of transfer means those kind of expenses which you incur in relation to the transfer. Commission, brokerage, etc. Only one expense is not allowed as a deduction, which is STT. Any expense which is not allowed as a deduction, which is STT. If you reduce this, you will get your net consideration. In this net consideration, you need to remove your cost of acquisition. Income tax says cost of acquisition means the actual cost which you have paid. Is what the consideration is. However, there are some special scenarios given to you. Scenario number 1, they are coming and saying if you have bought this asset before 1st April 2001, income tax says you can take actual cost or FMV on 1st April 2001, whichever is higher. However, if the asset which you have acquired before 2001 is a land and a building, then you need to take FMV or SDV, whichever is lower. That will be compared with the cost whichever is higher. Rahul, I have paid STT at the time of acquisition. Can I consider? No, STT will be ignored. Rahul, I have a house property. In that house property, I have paid some interest cost. I've paid some interest cost, but this interest cost I've claimed as a deduction under HP or Chapter 6A. Can I consider this interest cost? No. Amendment for the current year. Any interest cost which you have incurred, which you have already claimed under house property or capital gains, you cannot claim subsequent double deduction. You cannot claim a subsequent double deduction. You will ignore it off here. You will ignore it off here. Yes. Yes. Next, they are coming and saying, if you have bought any property which is a intangible asset, if you brought any property which is an intangible asset, tell me, have you self-generated the property? If you say yes, I will say the value is 0. If you say no, Rahul, I've purchased it, then I will say purchase price. Then I will say purchase price. Yes. Yes. Then I'm coming and saying, Rahul, if I have done any stock consolidation, stock disbursement and all those things, use your head, proportion the answer. Proportion the answer. If 100 shares has become 1 share, cost of 100 shares will be cost of 1 share. Cost of 100 shares will be cost of 1 share. If at all I'm not able to determine the cost, Rahul, if at all I'm not able to determine the cost, Rahul, I will take the cost which was there on the day of purchase. I will take the cost which was there on the day of purchase by treating the fair market value. By treating the fair market value. So FMV on the rate of purchase will become my cost of acquisition. Will become my cost of acquisition. If I have incurred any money to perfect my name in the will, then that is also included in my cost of acquisition, is what the case law says. Aditya Kumar Jagjodia. Aditya Kumar Jagjodia. If I am making some payment for perfecting my title in a property, allowed as a expenditure. Allowed as a expenditure. Yes, in this cost of acquisition, you have next thing called as advance forfeiture. Income tax comes and says that if you have taken some advance from someone and forfeited that advance, ask yourself, have you forfeited the advance before 1st April 2014 or after 1st April 2014? If you have forfeited the advance before 1st April 2014, you will reduce it from the cost of acquisition after indexation, before indexation. Before indexation. If you have done this forfeiture after April 2014, you will directly tax it off under IFOS. Tax it off under IFOS. Now notice carefully, provisions come and say that if you are going to do any kind of forfeiture before 2014, the reduction of cost of acquisition can only happen by the current owner. Can only happen by the current owner, which means if you have forfeited some money, and later on given this asset to someone else, on not a transfer basis, even then the forfeiture which you have done will become free profits, will not be taxable under any head of income, unless it is after 2014. Yes or no? Yes. Great. Leaving us with the last one called as cost of improvement. Income tax comes and says cost of improvement means those kind of improvements which you have done on the asset and not claimed as deduction anywhere else, which means these should be capital expenditures. Income tax says that if you have incurred some expenditure for improvement of any intangible assets, then in that case the value will be taken as 0. But if you have taken any kind of improvement after 2001, you can consider it for any non-intangibles. If you have taken any cost of improvement before 2001, you have to ignore the cost of improvement because it is already forming part of the FMV on 2001. Double deduction is not permitted, so therefore you will ignore all improvements taken before 2001. Yes or no? Yes. This was your cost of acquisition and cost of improvement. Income tax says if you have these cost of acquisition and cost of improvement, if you are having a long-term asset, you can convert this cost of acquisition and cost of improvement into cost of indexation with an indexation benefit. Indexation benefit comes and says that whatever cost you incurred multiplied by the CII in the year of transfer divided by the CII in the year in which the asset was first held by you, in the year in which the CII in the year in which the asset was first held by you will be treated as the index cost of acquisition and index cost of improvement. If you had purchased this property before 2001, indexations are only notified from 2001, so in that case you will take 2001. So in simple words, it is index cost of acquisition is cost of acquisition into CII in the year of transfer divided by CII in the year in which it is first held by the assessee, or CII in the year of 2001 and 2, whichever is later. Rahul, what are the indexation rates notified for exam? For exam, you only need to remember two rates. Rate of current year, which is 300 48, rate of 2001 and 2, which is 100. Rahul, if you're doing indexation, like I clarified to you, indexation will only happen from the date on which it is first held by the current assessee, which means even though the transaction is not regarded as transfer by the previous owner, cost and period of holding may come from previous owner, but indexation will only come from current owner unless and until you opt for the case of Manjulasha. Next, indexation provisions come and say that indexation will not be eligible if you have a bond or a debenture. Unless and until it is a capital indexed bond or it is a sovereign gold bond, these two assets alone will be eligible for indexation. No other assets are eligible for indexation in nature of bonds and debentures. Then we came and said that, Rahul, if you are a non-resident, who has bought some assets in foreign currency, in the form of shares and debentures, income tax requires that you compute your capital gains in foreign currency itself. By using the SBI average of SBI TT buying rate and SBI TT selling rate. To convert it into foreign currency. Whatever capital gains you get, that you convert into as average of SBI buying rate, that you convert using average of TTB buying rate on the date of transfer, and that will be the capital gains in Indian currency on which you will have to be paying taxes. Which means if you have any kind of transfer or cost of transfers in Indian currency, first converted into foreign currency using average of TTBR and TTSR, and then reconverted into capital gains. After computing capital gains, reconverted into Indian currency using average of TTBR. The next provision comes and says that if you have any rupee denominated bonds, whatever is the capital appreciation on the rupee part, relating to the rupee part, you need not pay taxes on this. So if a non-resident buys any rupee denominated bonds, to the extent the rupee becomes better and the capital gain comes because of the rupee conversion alone, that will not be taxable. Balance items will be taxable. Meaning the capital appreciation is taxable, the rupee appreciation is not taxable. Rahul, I have incurred rupee denomination, which means loss is there. You can claim it. This benefit is only for appreciation part, which means appreciation is exempted, depreciation is allowed. Yes, examples are there in the book. Moving on to the next topic called as exceptions to the year of transferability. Income tax says that generally your capital assets are taxable in the year in which the transfer takes place. Capital gains are taxable in the year in which the transfer takes place. However, 5 scenarios I'm coming and telling where it will not be taxable in the year in which the transfer takes place, but will be taxable in the subsequent years. First case is called as insurance compensation. What is it called as? Insurance compensation. Income tax says that if you have any insurance compensation received for a destruction of asset, the asset is assumed to be transferred on the date of destruction. But will be taxable only in the year in which the compensation is received. Which means in this case you will have to stop indexation on the date of destruction. But you will have to pay the tax on this only in the year in which the compensation is received. Rahul, what will be my full value of consideration? It will be the cost of, it will be the money which I am receiving from insurance company. My period of holding will be from the date of purchase of the asset till the date on which the asset is destroyed. Please understand very carefully. Even though you are going to pay tax in the year in which the compensation is received, the period of holding will stop on the date of destruction. The indexation will stop on the date of destruction. Next, receipts from ULIPs. Income tax comes and says that if at all you have purchased ULIPs after 2021, if you have purchased any ULIPs after 2021 and the ULIP premium is going beyond 2,50,000, then the ULIP is now fully taxable on maturity basis. Full value of consideration will be the maturity amount. Cost of acquisition will be all the premiums which you have paid from first date till the date of redemption. That will be your capital gains. It can be short term, can be long term, doesn't matter. The point is tax will be collected in the year in which the proceeds are received from the policy. Yes. However, in case you have taken multiple ULIPs, In case you have taken multiple ULIPs, up to 2,50,000 worth of premium in a current year can be exempted. Any other policy which is having more than 2,50,000 or after the 2,50,000 will be taxable. Which means if you have multiple policies, take certain policies up to 2,50,000, you can treat them as non-taxable. Balance policies, you can take them as taxable. Who has to make the decision, Rahul? You are to make the decision on your own. There are examples given in the book of IFOS. When we do IFOS, we'll come back to this once again. Yes. Next, any kind of conversion of capital asset into stock and trade. Notice very carefully. First conversion should be capital asset. Second conversion should be a stock and trade. If you are going to convert a capital asset into stock and trade, on the date of conversion, whatever is the fair market value will become your full value of consideration. Under capital gains. So you will compute capital gains accordingly. The same fair market value will become the cost of acquisition for the stock, for the purpose of you to compute your PGBP. The only check point here is that if you are going to convert your capital asset into stock and trade, the tax of the capital gains will be paid only in the year in which the stock and trade is sold. Yes or no? Yes. Reverse scenario. You are going to convert your stock and trade into capital asset. Notice carefully. Here they are coming and saying if you are converting your stock and trade into capital asset, the first gains will be PGBP gains. The second gains will be a capital gains. In this also, the fair market value on the date of conversion will be used as the full value of consideration for the first scenario and cost of acquisition for the second scenario. But regardless of it, this provision comes and says that if you are going to convert stock and trade first, PGBP will be taxable in the year in which the conversion takes place, and capital gains will be paid in the year in which the asset is transferred. So notice carefully, if capital asset is transferred into stock and trade, then capital gains will be paid in the year on stock and trade sales. But if stock and trade is converted into capital asset, stock and trade will be taxable in the year of conversion. Capital asset will be taxable in the year of transfer. Independent scenarios. Please be very careful. Then, if you have any compulsory acquisition happening, income tax says that if at all government is going to compulsorily acquire your properties, in that case you will be liable for capital gains, because even compulsory acquisition is a transfer. However, the compensation, the year of taxability will be the year in which the first installment of the compensation is received. The taxability will be the year in which the first compensation is received. However, it doesn't change the fact that period of holding will stop on the date on which the asset is compulsorily acquired. Indexation will stop on the date on which the asset is compulsorily acquired. If you feel like it, you can decide to go and ask for enhanced compensation to a court. If you feel like it, you can decide for asking an enhanced compensation to a court. In case the court decides for an enhanced compensation, the enhanced compensation will be taxable fully. Because there is anyway no cost. So whatever is the enhanced compensation which you receive will be taxable fully in the year in which the compensation is received. However, if you are going to receive this compensation by way of an interim order, even though the money is received in an interim order, it will only be taxable in the year in which the final order is passed. For all enhanced compensations, whether it is actual or interim, it will be having the same nature of capital gains as your original compensation. The only challenge is here you will not have any cost of acquisitions. Apart from that, the nature will remain the same. Yes. Next, the provisions come and say that if at all you are going to receive any enhanced compensation, any interest which you have got along with this enhanced compensation will be taxable under the head IFOS, with an exemption of 50% of the money received. Second exemption comes and says that if at all you are having any agricultural land, and that agricultural land has been acquired by the government when you are an individual or a HUF, the agricultural land will not be taxable under the head capital gains. The agriculture income will not be taxable under the head capital gains. Next comes your case law. The case law comes and clarifies that yes, if you have any asset which has been compulsorily acquired, and you wanted to increase the compensation, you had an option to go to the court. But if you did not want to go to the court, but you went to the collector office and you negotiated with him to increase the price automatically. You negotiate with him to increase the price automatically. It does not change the fact that the asset was still compulsorily acquired. It does not change the fact that the asset was still compulsorily acquired. Just because you do an out of court assessment or agreement or settlement, just because you do an out of court assessment, agreement or settlement, the nature of the acquisition does not change from capital compulsory acquisition to voluntary sale. It will continue to be compulsory acquisition, and therefore you can claim your benefits. You can claim your benefits. Next comes your specified agreement. Income tax comes and says that if at all you have an individual and HUF having a land who gives away his land to someone for constructing a building on it, in consideration for getting a portion of the building along with cash, any one of those two is not mandatory. Any one of those two is not mandatory. It is any kind of property which you give for getting a building in exchange, along with cash. In that case, even though the asset is transferred to the person on the date of giving away, the tax will be collected only in the year in which the building is completed. However, if you jump too much and you sell the property, you sell your rights even before you get the building, then the year in which you sell the rights, you have money in your hand. That year itself you will have to pay tax. Yes, these are your 5 exceptions. The summary is here. The 5 exceptions summaries. Yes, moving on in the capital gains chapter, you have some special scenarios coming in. The special scenarios come and say that if you are planning to buy any, if you are planning to get any bonus, cost of acquisition of the bonus will be 0. But if you are going to buy this property, if you are getting the bonus before 1st April 2001, you are free to use the fair market value as on 1st April 2001 because that is more beneficial. Then if you are planning to get any rights, if you exercise the rights, then the cost of acquisition is the price which you pay. If you plan to renounce the rights, then your capital gains will be the price which you gave to someone. The price at which you gave it to someone minus cost is anyway 0, so therefore it will be full capital gains. Yes. And if the other person is buying the rights from you, now this person has paid 2 places. One, he is paid it to you for getting the rights. Second, he is paid it to the company for getting the shares. Both will be added to the cost. So the cost of acquisition for the new owner will be the renunciation price plus the price which is paid for allotment. You will consider both the costs. Yes, can we go forward? Let's go forward. The provisions come and say that if you are having any kind of shares in demat format, the shares will be taxable in the year in which the shares are sold. But if at all you have shares, you don't know how to compute the cost of acquisition, assume FIFO basis. Now understand carefully, FIFO basis is the date on which the assets are come into the demat format, which means if you had shares in physical format and you have put them into demat format, the day when you put it into demat format, that is the date on which it is brought into demat conditions. FIFO will start from that date. If any assets are there before that period, even if it is a latest asset, that will be considered as first in, first out. Depreciable assets, we have already discussed this in capital gains. If you have any depreciable assets, you have to transfer this asset only by treating it as a short-term capital gain. But this provisions will only apply in case the block ceases to exist. Which means either you sell off the whole block or you sell the block in such a way that the consideration is more than the block itself. Only in that case will you come to depreciation of capital gains, depreciable assets for capital gains. Otherwise, you will continue PGBP. And capital gains will not apply, which means it is either capital gains or PGBP. It cannot be both. If you have block available, then in that case it is PGBP. If you don't have the block available because you have sold it at a price more than the cost, or all the assets in the block are sold off, then in that case you will do depreciation. In that case you will do capital gains. Simple, straightforward scenario. How do you do capital gains? Full value of consideration will be the amount which you received minus cost of acquisition will be the WDV as on the last day of the previous year. Because current year you will not give depreciation. Current year depreciation can only be given in case the asset is there until 31st March. Asset is there till 31st March. If the asset is not there till 31st March, current year anyway depreciation is not eligible, which means you cannot claim depreciation for the current year. You cannot claim depreciation for the current year. Yes, yes, yes. After depreciable assets, the provisions are coming and saying merely because free assets in the block are not used for business purposes. Okay, the case law is basically coming and saying that there was a person who did not use the assets for a few years. There is a person who did not use the asset for a few years. So he came and said, this is not depreciable asset anymore. I want to do long-term gains. I want to do long-term gains. Income tax came and said, the case law came and said, the moment you have put them into the block, they become a depreciable asset. It is not important if the asset is used or not used. You will still consider that as a depreciable asset and put it under short-term capital gains and not under long-term capital gains. Case law is Shakti Metal Depot. Shakti Metal Depot. If you have put something in the block will consider this as a short-term capital gains and will never move it back to long-term capital gains. Understand? I am only talking about gains. I am not talking about the asset. Asset is still long-term asset. Asset is still a long-term asset. The gains alone is a short-term gains. The gains alone is a short-term gains. Why is it relevant? We will discuss later. Coming to the amendment of the current year. The amendment of the current year comes and says that if you are planning to buy any market-linked debentures, or you're planning to buy any mutual funds in which less than 35% of the mutual fund is invested in equity shares. Less than 35% of the mutual funds is invested in equity shares, which means most of the funds are coming from debt. In that case, income tax comes and says that these assets will now forever be called as short-term assets. These assets forever will now be called as short-term assets, and so will be always considered as short-term capital gains and long-term capital gains, even though period of holding is given. Regardless of a period of holding, these assets will always become short-term capital gains and short-term capital loss, because the asset itself is short-term in nature. Clear? Yes. Next comes your exemptions. Income tax comes and says there are certain exemptions which are there for you. I think in the class we discussed 3 exemptions are most important: 54, 54F and 54 EC. 54, 54F and 54 EC. Let's do 54 and 54F. Income tax comes and says that if you are planning to sell a house, in order to buy a house, it is 54. If you are planning to sell any other long-term asset in order to buy a house, it is 54F. Those kind of scenarios, you have to buy a house in India. If you are planning to buy a house in India, then in that case you can claim an exemption under section 54 or 54F. Asset to be transferred can be residential house property for 54 and any long-term capital asset for 54F. Any asset for 54F. If you want to buy assets, you have to buy one residential house property in India under 54. However, if you have a long-term capital gain up to 2 crores, once in a lifetime offer I am giving to you, you can buy 2 house properties in India. Once in a lifetime offer. Now here is where they have put a case law. The case law comes and says that if at all I have 2 properties, the properties are adjacent to each other in such a way that you can break the wall in the middle. Assume that property as one property and not 2 properties. Assume the property as one property and not 2 properties. So 2 properties, adjacent wall broken, will be called as one property. There you are still eligible for exemption for both the properties. Even if the capital gains goes beyond 2 crores. Yes, so in 54 you have to buy one residential house property in India or 2 residential house properties in India up to where your LTCG is up to 2 crores. If you are in 54F, they come and say you sell all your long-term capital assets, buy one residential house property in India. When you are buying this one residential house property, the condition is that beyond this property you should not have any other property more than one. Which means you can maximum have one more property other than this property. If this is the 3rd property which you have, then it's not eligible for exemption. You are eligible for exemption only if this is the 1st property or the 2nd property. Okay. At the same time, they are coming and saying during the course of your construction period, you should not buy any other property also. During the course of your construction also, you should not buy any other property also. So maximum after the property is completed, you should have only 2 properties. Yes. Yes, Rahul, until what time can I buy this property? You can buy this property. If you are going to buy the property, you can buy it 1 year before or 2 years after the date of transfer. But if you're planning to construct the property, you can start construction whenever you want. You can start construction whenever you want, as long as you complete the construction within 3 years from the date of transfer. 3 years from the date of transfer. How much should I invest, Rahul? In 54, you should invest the capital gains. In 54F, you should invest the net consideration. You should invest the net consideration. But here is where comes the amendment for the current year. Here is where comes the amendment for the current year. Amendment of the current year says that the total investment in the house should not go more than 10 crores. The total investment in the house should not go more than 10 crores. So which means if you're going to invest capital gains in 54F, you have to invest maximum 10 crores. If you're going to invest the net consideration in 54F, you should invest only 10 crores of net consideration. You should invest only 10 crores of net consideration. Rahul, what if I don't invest the full number? What if I don't invest the full number? In 54, you will get the exemption to the extent of the amount you invested. To the extent of the amount you invested. But in 54F, since they're asking you to invest the net consideration, you need to do proportionate basis. You need to do proportionate basis, which means if I would have invested 10 crores, I would have got 5 lakhs, for example. If I invest only 8 crores, how much will I get? How much will I get? Proportion the answer and then get the exemption. Proportion the answer and get your exemption. Rahul, whatever house property I have bought, I have to hold this house property for a minimum period of 3 years. For a minimum period of 3 years. If I do not hold the property for the stipulated period, the exemption which I claimed earlier will be reduced from the cost of acquisition in case of 54. The exemption which I claimed earlier will be reduced from the cost of acquisition in case of 54, and the exemption which I claimed earlier will become taxable in the year of sale in the 54F. In the 54F, Rahul, how do you remember this? The logic is very simple. If the asset which you initially transferred and the asset which you now acquired are the same assets, exemption will be removed from the cost. Exemption will be removed from the cost. If the asset which you transferred is different from the asset which you acquired, then the exemption which you claimed earlier will be taxable separately. Current year sales will be taxable separately. Current year sales will be taxable separately. Yes or no? Yes or no? Yes. Now here is where the second case law comes and says, the second case law which we had in 54F came and said that if you are going to have a sale value, and you invest that value, then it is eligible for exemption. Assuming that your stamp duty value was more than your sale value. Assuming that your stamp duty value was more than your sale value and you got money from some other source to the extent of stamp duty value, you are still eligible for exemption. You are still eligible for exemption. Assessing officer cannot come and say that you only received a full value of consideration as actual consideration in your hand right now, and therefore any investment happening beyond actual consideration cannot be claimed as exemption. When the income tax computation itself allows stamp duty value to become the full value of consideration, investment happening to that extent is also eligible for exemptions. Eligible for exemptions. Yes, yes. Next, 54 EC. Next, 54 EC. 54 EC comes and says that if you have any long-term land and building which you're planning to transfer in exchange for acquiring any NHCI bond or REC bond or any other notified bonds, you can claim an exemption under 54 EC. Yes, the requirement is that the asset which you're transferring should be a long-term capital land and building. Long-term capital land and building. The asset which you're planning to acquire should be an NHCI bond, REC bond, or any other notified bonds. How much should you invest, Rahul? You should invest your capital gains in this. By when should you invest, Rahul? You should invest within 6 months from the rate of transfer. How much can I invest, Rahul? You can only invest maximum 50 lakhs. You can only invest maximum 50 lakhs for all assets covered in a single financial year. For all assets covered in a single financial year, which means if an asset is covered in a single financial year and you are going a spread over various financial years also, maximum exemption you can claim 50 lakhs for that asset. Maximum exemption you can claim is 50 lakhs for that assets. Yes, any kind of capital gains which you invested, the bonds which you got should be held for a period of at least 5 years. If you do not hold it for a period of 5 years, since the asset which you acquired is different from the asset which you transferred, exemption which you claimed earlier will be taxable in the year of withdrawals. Taxable in the year of withdrawals or taxable in the year of sale, as the case may be. Taxable in the year of withdrawal or taxable in the year of sale, as the case may be. Income tax says that if you are going to buy any bonds, please do not put any lien on the bonds. Please do not put any charge on the bonds. Please do not convert the bonds into stock in trade. All those will also be considered as a sale, and therefore it will be treated as a violation. It will be treated as a violation. It will be treated as a violation. Yes. Now, the balance exemptions which you have in this chapter are not very relevant for you to remember per se. It is enough if you remember that in exam, if you see an asset being transferred and then you see an asset being acquired, it is most likely because there is a capital gains exemption coming into picture. Keeping that in mind, 54 comes and says, if you transfer any agricultural land in order to buy another agricultural land, 54B exemption comes into picture. Requirement is the transfer asset should be an urban agricultural land. The acquired asset should be either an urban agricultural land or rural agricultural land. Periods will almost remain the same. It is 2 years from the rate of transfer. Amount to be invested is capital gains. If you do not invest the capital gains, then the asset which you have is the same asset, and therefore the exemption which you claimed earlier will become taxable right now if the asset is sold within a period of 3 years. If the asset which is sold within a period of 3 years, the exemption which you tried to claim earlier will become reduced from the cost of acquisition in the current year. Then you have 54D. Then you have 54D. 54D comes and says, if government is going to compulsorily acquire your land and building which is industrial in nature, and then you are going to purchase another industrial land and building, then whatever is the land and building which was acquired will be eligible for acquisition, will be eligible for exemption, provided it is any asset long term or short term. You should acquire the new asset within a period of 3 years. You should invest your capital gains for the purpose of exemptions here, and you should hold the asset for a period of 3 years. Since the assets are the same, the exemption which you claimed earlier will be reduced from the cost of the acquisition in case the transfer happens within 3 years. The case law which is there a little bit on the top is linked to both the sections. The case law comes and says that if at all you are planning to buy a land, or any other building for that matter, the money is invested by you. But you have made your family member as a relative, as a co-owner. If you have made your family member as a co-owner, it does not change the fact that you have still invested money from your side, and therefore you are still eligible for exemptions. Merely because you put your family member as a co-owner does not change the substance of the ownership. You are still the owner of the house or the property or any other asset for that matter, and you can still claim an exemption. Yes, the same logic works in another way also. If you put all the money into the house, but you put the house in the name of the wife, it doesn't change the fact that the money was put by you, control is with you, and therefore right is also with you. You are still eligible for exemptions. Next comes 54. F or a case law. The case law comes and says that if at all you're going to purchase a house, small work spending in the house like flooring, painting and all those things does not change the fact that the house is already acquired, and therefore the house will be assumed to be completed, and therefore you will be eligible for full exemptions. The other case law is in 54EC, which comes and says that if at all you have a depreciable asset, please understand that the resultant gains is a short-term capital gain or short-term capital loss. It does not change the fact that the asset was a long-term capital asset. It does not change the fact that the asset might have been a long-term capital asset. So even though you have a resultant short-term capital gain, you can claim 54EC benefits. As long as you can prove that the asset was a long-term capital asset. Then moving to the last two, called as 54G and 54GA. 54G comes and says, if you're planning to have any industrial undertaking sold off, urban industrial undertaking sold off in exchange for buying any rural industrial undertaking or for buying any SEZ unit, in that case whatever money you transferred will be exempted to the extent of capital gains investment made in the new undertaking. Undertaking should be made within 1 year before or 3 years after. Put capital gains into this. Since the asset would be same, both are the undertaking, any kind of exemption which you claimed earlier will be reduced from the cost of the acquisition if you do not hold the asset for a period of 3 years. And then the case law comes and says the requirement will be satisfied if the capital gains is given as an advance for acquisition of capital assets such as land, building or plant and machinery. So if you have paid money from your side, even if it is an advance, it is still eligible for exemption. Having the ownership in your name is not a prerequisite. Is not a prerequisite. Please keep that in mind. Yes, the same provision is there in 54 EC also. 54 EC, what happened is the bond was given to you after the 6 months period, but you had invested the money within 6 months period. You had invested the money within 6 years, 6 months period. The courts decided that since you gave off the money, it is still eligible for exemption. It doesn't matter that the allotment happened on a later date because it is not your mistake. It is not your mistake. You have satisfied the payment conditions. You have satisfied the payment conditions. Last one is 54 GB. Last one is 54 GB, not so relevant from exam perspective, but it is there. The provision come and say that if at all you are an individual or HUF who has a residential house property, planning to transfer the residential house property in order to buy shares of an startup which you created, then in that case you can claim exemption of the eligible startup shares investment. You can claim the investment eligible startup, you can claim the exemption to the extent of the money which you deposited in the shares of the eligible startup, provided the money which you have deposited in the eligible startup is also used for purchasing further plant and machinery. It is also used for purchasing further plant and machinery. So the sequence is you sell the house, buy shares of the startup, startup should buy plant and machinery. Startup should buy plant and machinery. You should invest in the startup by the return filing due date. The startup should buy the plant and machinery within a period of 1 year from the date of getting the money. From the date of getting the money, how much should you invest, Rahul? You should invest your net consideration here. So in capital gains, there are only two sections which are having net consideration investment. One is 54F, one is 54 GB. One is 54F and 54 GB. These two have net consideration criteria as the investment mechanism route. If you do not invest your net consideration, then in that case you will have a proportionate exemption, will be taxable in the year of violation. What is the period of holding, Rahul? If you are having the shares of the company, you should hold it for a period of 5 years. If you have the plant and machinery should be held it for a period of 5 years. But if you are going to have any computers and computer software, it is enough if you hold it for 3 years. Minimum you should satisfy this much. If you violate this, then the exemption which you tried to claim earlier will become taxable separately because the assets are different. Now in all these scenarios, wherever I told you that the time limit to acquire is longer, like 54, 54F, 54B, 54D, 54G, 54GA, wherever the time limits to acquire is longer, income tax has enabled an option called as CGAS, Capital Gains Account Saving Scheme, where they come and say that even if you do not know that you will buy the asset today, if you invest the money within a due date of return filing, into the CGAS scheme, the amount will still be allowed as an exemption. Provided the money which is there in the CGAS scheme is only used for the purpose for which you have put it. Putting it in the place where you had assigned it to it. If you violate or misuse this condition, then the year in which you violate the condition, that year it will become taxable. Second, they are coming and saying that if at all you have any capital gains which is going to be taxed on a future date because of the exceptions, the insurance compensation, the depreciable assets, the conversion, not depreciable assets, insurance compensation, compulsory acquisition, conversion of capital asset into stock and trade. In all those cases, whenever your tax is going to be collected on a future date, the period for exemption will also start from that date only. It will not start from the date of actual transfer. You can sufficiently comply with the provisions of the law as long as you deposit the money starting from the date on which the tax on the transfer is collected. Yes, great. Leaves you with the last topic in capital gains chapter, which is the tax rate. A fairly simple provisions. They're coming and saying that, Rahul, in capital gains there are 4 kinds of capital gains. One is long term 112A, long term 112, short term 111A, and short term others. Income tax comes and says if you are planning to transfer any listed equity shares, any equity oriented funds, or any business trust units, if you have these kind of assets and if it is found to be long term in nature, then it is long term capital gains under 112A. If it is not found to be long term in nature, then it is short term capital gains under 111A. So any kind of listed equity shares, equity oriented funds, or business unit trust, if you transfer it as a long term asset, then it is one long term asset at the rate of 112A, and if it is not long term, then it is short term asset under 111A. Any other assets, if they are found to be long term, then it is long term asset under 112, and if it is found to be short term, then it is short term under Finance Act. It is short term under Finance Act. Income tax comes and says if you have any capital gains under 112A, tax rate is 10% in excess of 1 lakh. If you have any short term capital gains under 111A, tax rate is 15%. Tax rate is 15%. If you have any long term capital gains under 112, it is 20%, and if it is any short term capital gains under Finance Act, then it is slab rate income. Then it is slab rate income. However, there are some conditions. 112A has a condition that whatever assets you have, the listed equity shares, the equity oriented funds, the units of business trust, you should pay STT on those. You should pay STT on those. In fact, for equity shares, you need to pay STT both at the time of acquisition and at the time of transfer. At the time of acquisition and at the time of transfer, at both times you have to pay the STT. For other two cases, it is enough if you pay STT at the time of transfer. Yes, if you do only this only, then the assets will be classified under 112A and will be liable for tax at the rate of 10% in excess of 1 lakh. If you are going to do that, then only it will be taxable. Then only it will be taxable, with an exception given to you that if at all this transfer is happening in an IFSC unit. If the transfer is happening in an IFSC unit, 112A will apply even if STT is not paid. Even if STT is not paid, because one IFSC units STT is not there. For IFSC unit, STT is not there. Yes, provisions are coming and saying if you have something under 112A, you cannot claim any indexation benefits on those assets. You cannot claim any indexation benefits on those assets. You cannot claim any rebate on those assets also. You cannot claim any rebate on those assets also. But your surcharge will be restricted to 15% maximum. Surcharge will be restricted to 15% maximum. Yes, this is what 112A is. After 112A came 111A. 111A comes and says that if at all you have any listed equity shares or units of equity oriented funds or units of business trust on which you have paid STT only at the time of transfer, and it is found to be a short term asset, then in that case it will be taxable as short term capital gains under 111A at the rate of 15%. Same IFSC unit, STT not required to be paid, still 15%. Here you will be eligible for benefit of rebate also. Here you will be eligible for benefit of rebate also. Anyway, indexation was not eligible, so forget it off. In your benefit of rebate will come to you, maximum surcharge 15%. Maximum surcharge 15%. Yes. Now in this, what happened is income tax also came and notified that it is not mandatory that STT will always be payable. It is not mandatory that STT will always be payable. If at all STT was not even payable at the time of acquisition, you are free to treat it as 112A itself. You're free to treat it as 112A itself. If the provision itself is not there, there is no condition for you to satisfy it. There is no condition for you to satisfy it. So there is a long list of theory. There is a long list of theory where they come and say even if STT was not paid at the time of acquisition, it is still okay. It is still okay as long as STT was not even payable. As long as STT was not even payable. But the most important thing in this is your cost of acquisition. Income tax comes and says that if at all you are having a long-term capital asset which is covered under 112A, and it was acquired before 2018, it was acquired before 1st February 2018, then in that case you need to do the actual sale value or FMV on 31st January 2018, whichever is lower. What you need to do? You need to do your actual sale or FMV on 31st January 2018, whichever is lower. Compare it with the actual consideration, whichever is higher. This value will now become your actual cost of acquisition. So whatever is your sale value, in that you can reduce this new cost of acquisition. Please understand, this provision is only if you have purchased the asset before February 2018. What is it once again? It is sale consideration or FMV on 31st March 2018, whichever is lower, compared with the cost, whichever is higher. If you have purchased the asset anyway after 2018, no worries. Then in that case, it is the actual cost only. This provision will only apply in case you have purchased it before 2018. Now, how to find out the FMV, Rahul? The question comes and asks you how to find out FMV. You have to come and ask him, tell me whether the asset was listed on 31st January 2018 or not listed on 31st January 2018. If they say, Rahul, the asset was listed on 31st January 2018, then you have to take the highest price quoting on that date. Or if the asset was not quoted on that day, any highest price on the previous date. But if you tell me, no, Rahul, the asset was not even listed on that period. The asset was not even listed during that period. Then in that case, I will say if it is a unit, then it is NAV of the unit on 31st January. If it is a unit, then it is NAV of the unit on 31st January. If it is a asset in the form of shares, if it is an asset in the form of shares, then you will assume the FMV to be the indexed cost on that date. You will assume it to be indexed cost on that date, which means it will be FMV equal to cost of acquisition into CII in the year of 1718, because it is assumed to be indexed that day. So CII in the year of 1718 divided by CII in the year in which the asset was first held, divided by CII in the year in which the asset was first held. This is your 112A, special provisions in case of cost of acquisition. Special provisions in case of cost of acquisition. Yes. Moving on to the last two topics, which is your 112. Income tax comes and says that if at all you have any asset which is not covered as 112A, then the asset automatically becomes 112 and taxable at the rate of 20%. However, I am giving you certain additional benefits. If the asset is found out to be a listed asset, or it is found out to be a zero coupon bond, I am giving you an option. You are free to take the tax rate as 20% with indexation. But if you want, and you find that your without indexation the rate of tax 10%, without indexation, if you use 10% rate of tax and the asset amount comes lower, you can choose that also. In simple words, it is 20% with indexation or 10% without indexation, whichever is beneficial to the assessee. 20% with indexation and 10% without indexation, whichever is beneficial to the assessee, only in case the asset is a listed security or a zero coupon bond. Next, they are telling if you are found to be a non-resident, and you have some unlisted securities, then in that case I don't mind. I will make the tax rate directly as 10%. I'll make the tax rate directly as 10%, subject to the condition that I will not let you claim any indexations, nor I will let you do computation of capital gains in foreign currency. I'll let you do the capital gains computation in foreign currency. That is what we discussed some time back. Computing in capital currency, we're using TTBR. Yes, both of those things will not be permitted to do, but I will give you the tax rate as 10%. Please note, this is a mandatory provision. Here I am not giving you an option. I have told it is 10%, it will only be 10%. Coming to 112, are you eligible for rebate? Yes. Are you eligible for indexation? Yes. Are you, what is your maximum surcharge rate? 15%. What is your maximum surcharge rate? 15%. And for all the assets we discussed right now, 112, 112A and 111A, if you are a resident person, and it is found that your basic exemption limit is still not exhausted, please feel free to use your capital gains into your basic exemption limit. Please feel free to put your capital gains into basic exemption limit and not tax it off, only to the extent of basic exemption limit. We have already discussed this in rates of taxes, but clarifying it once again. With this marks the end of your chapter called as capital gains. You have some summaries in the capital gains for you to discuss, whether what is the indexation rate, at what period of holding, what will be taxable, what is the rate of tax, everything is there in the notes. Check it out once. Yes. Quickly moving to the next topics, which is your business reorganization. There are 4 kinds of business reorganization you have: amalgamation, demerger, conversion and slump sale. Income tax says if 2 companies are coming together, it is called as amalgamation. If one company is splitting into multiple companies, it is demerger. If one entity is becoming another entity, it is conversion. And if you're going to give one undertaking as a going concern to someone else, it is called as slump sale. Income tax comes and says if at all there is a transaction of amalgamation, and this is found to be an amalgamation in the nature of merger under accounts, then in that case the amalgamation will not be taxable under Income Tax Act. It will not be taxable under Income Tax Act. The cost of acquisition for the new company will be cost to the previous company. Period of holding of new company will be period of holding of previous company. Indexation for new company will start from new company. If the shareholders of the amalgamating company are receiving shares of amalgamated company, in that case also it is not regarded as transfer. The shares of amalgamated company will be shares of the cost of acquisition of amalgamating company shares. Amalgamated company shares will be cost of acquisition of amalgamating shares. Period of holding of amalgamated shares will include period of holding of amalgamating shares. Indexation will anyway be available from the old shares itself because same as a C. Next comes your demerger. If you have one entity which is split into multiple entities, then it is called as demerger. Again, they said demerger should be in the nature of merger. Pooling of interest method is important, which means assets should be transferred at book values. The shareholders of the old company should become shareholders of the new company, and all those conditions. Same. Any kind of transfer will not be liable for capital gains. Cost of acquisition will be proportion cost difference. Which means the cost of acquisition will be the cost to the previous owner to the extent of the assets transferred. Period of holding will also include the period of holding of previous owner. However, if the shares are, if the shareholders are receiving the shares of the resulting company, this is kind of received at free of cost. They said the old cost of acquisition which you have, you will split between the old company and the new company. In the proportion of the assets transferred to the net worth of the business. So therefore they came and said cost of acquisition of shares in the resulting company will be cost of acquisition of the original shares into book value of assets transferred divided by net worth of the undertaking. What will happen to the old shares, Rahul? To the extent the cost you have moved away, that you will remove off, balance will remain here. So cost of acquisition of the new demerged company will be cost of acquisition of the old shares minus the cost of acquisition transferred to resulting company. This is your demerger scenario. Moving on to the last one, called as conversion. Income tax says that if you are planning to convert one entity to another entity, what are the kind of conversions I have told? It is conversions between partnership firm to a company, AOP or BOI to a company for recognized stock exchange, any kind of private company or unlisted public company into LLP, and any kind of into LLP. There is an individual also, no? Any kind of individual concern to company. In all these transactions, the transfer will not be regarded as taxable nature. Therefore, period of holding will be period of holding of previous owner. Cost of acquisition will be cost of acquisition of previous owner. All the sections. One mandatory condition which is there is that the shareholders of the old company should become the shareholders of the new company. Okay, so the owners of the old company, the owners of the old entity should become owners of the new entity and at least hold 50% of those new entity. In terms of profit or in terms of voting power, as the case may be. If you do violate all these conditions, then the year in which the violation took place, that year you will tax it off. The year in which you violate the conditions, that year you will tax it off. Moving on to the last and the most important thing in this chapter, called as slump sale. Income tax comes and says, if you are planning to transfer any undertaking as a going concern, what are you doing? You are transferring any undertaking as a going concern. In that case, income tax comes and says that the assets which you transferred minus the liabilities which you transferred, minus the liabilities which you transferred will be taxable as slump sale. Condition is that whatever money you receive should be at least the fair market value of the assets which you transferred. Which means if you have transferred assets worth 100 crores in fair market value, you should receive 100 crores in terms of money or assets. If you do not receive that much also, then in that case I will consume the fair market value of the assets transferred as the full value of consideration. I will assume the fair market value of the assets transferred as the full value of consideration. So therefore, if you notice on the board, it says full value of consideration is fair market value of the assets transferred minus the cash plus assets received, whichever is higher. This will become your full value of consideration. From this full value of consideration, you will reduce the cost of acquisition. In slump sale scenarios, cost of acquisition is your net worth. Net worth means assets minus liabilities as per the books of accounts, adjusted with income tax. How do you find out your net worth, Rahul? Take up all your assets. If the asset is a depreciable asset, put the asset value as depreciable asset, WDV as per Income Tax Act. If it is any self-generated intangibles, then the value is 0. If it is any asset on which you have claimed big deductions under 35 AD or 35 and all those things, again the asset cost will be 0. If you are having any other assets, then the assets will be valued at book value. If you have any liabilities will also be done at book value. At any point of time. If your accounting books has any revaluation done, income tax does not favor revaluation, so you will ignore those revaluations. For the purpose of cost. Now come back to the FVOC. In FVOC, we are coming and saying it is fair market value of the assets transferred or cash, whichever is higher. So you need to find out how to find out the fair market value of assets transferred. Income tax comes and says, look at all your assets and liabilities. All assets and liabilities, take it at realizable value or book value, whatever it is. But if the asset is a immovable property, take stamp duty value. If the asset is a immovable property, take stamp duty value. If the asset is a jewelry and all those things, then you have to take it at the fair market value. If the asset is a jewelry and all those things, you have to take it at fair market value. So they came and said, if it is a jewelry and all, take fair market value. If it is immovable property, take stamp duty value. Every other asset you can take it at book value. But you will have to remove any tax related components. Like advance tax, TDS, any kind of provision for tax. All those things have to be removed, and then remove any deferred revenue expenditures. All those items you will remove. So in simple words, fair market value of the assets transferred is all assets at book value except for immobile, which is at a stamp duty value, jewelry, which is at open market value, and removal of any taxes and deferred revenue. If you also have any investment in some other company, that some other company should also be fair market valued using the same logic which you are doing right now. Fair market value those assets also. This will arrive at the asset side. From this you will have to remove the liabilities. What will you have to remove? Liabilities. What will you remove, Rahul? You remove the realizable value of the liabilities or the book value of liabilities, except for any capital, reserve and surplus, any kind of provision for tax, and any kind of contingent liabilities or unascertained liabilities. That alone you will remove off. Balance everything will be taken at book value. Since you are doing slump sale and all the assets are valued at the latest date, there is no indexation given to you, but you will still tax them as long term or short term depending on when the undertaking was opened. If the undertaking was opened before 36 months, then it is long term capital asset. If the undertaking was opened after 36 months, then it is short term capital asset. At any point of time, whether it is long term or short term, you will not give any benefit of indexations. Yes, great. Moving on to the last chapter, which is your taxation of transaction with owners. The topic which we did today. I came and clarified to you that you have three items. You have two people talking about here. One is company, one is firms. In case of company, you can distribute money to your owners in the form of dividends, taxable under IFOs. You can distribute in the form of buyback. Income tax comes and says, if you are planning to distribute someone money in the form of buyback, tell me, are you going to buy back shares or are you going to buy back securities? If you are going to buy back securities, then the money will be taxable in the hands of shareholder as capital gains. Money will be taxable in the hands of shareholders as capital gains. Same format. Full value of consideration minus cost of transfer minus cost of acquisition, and all the same formats. If you say no, Rahul, this is shares, then I will come and ask you, is this shares of domestic company or is it shares of foreign company? If you tell me it is shares of foreign company, I cannot have a control over foreign company, and therefore the same logic, which means capital gains will apply in the hands of shareholders. Same format. The issue comes when you have shares being bought back from a domestic company. Income tax comes and says, if a share is being bought back from a domestic company, then the capital gains will not be applicable. It will become exempt in the hands of shareholders. Will become taxable in the hands of the company. Will be taxable in the hands of the company in the form of buyback tax. Buyback tax provisions come and say, buyback tax means buyback gains into 20% tax plus 12% mandatory surcharge plus 4% mandatory cess. You need to pay this 20% plus 12% plus 4%, irrespective of the fact that you have income, not an income, you have gains, not a gains. If the shareholder is rich or the shareholder is poor, you are rich or you are poor, it doesn't matter. Flat rate of 20 plus 12 plus 4, which is 23.296. Now, what has this to be paid on? This has to be paid on your buyback gains. What do you mean by buyback gains, Rahul? The price at which you bought back the share minus the price which the first shareholder got. The shares from your company. Shares at your company. So this will be taxable in the hands of the company on behalf of the shareholder, and so shareholder will be exempt from taxes. Whatever tax you have to pay under buyback tax has to be paid within 14 days from the date of buyback. How do you compute the costs, Rahul? Various scenarios are given to you. In simple words, like I told you, it is the initial price which the shareholder paid to you at the time of buyback. The initial price at which the shareholder paid to you at the time of buyback. After that, if at all there is any modifications which has happened, that also can be considered. Like if at all part buyback and all happened in the next few days, then that also can be reduced from the cost. All those have to be considered. Go through these illustrations yourself. Fairly simple logics. Yes, Rahul, if it is not a buyback, it is a liquidation. Income tax comes and says, if at all the company is getting liquidated, in the liquidation company, to the extent the company has profits, that money which is given to the shareholders will be assumed as dividend under IFOS. So for example, if the company gives 100 crores to shareholders and it is found that the profits in the company is 20 crores, it will be assumed that 20 crores of profit is dividends. And the balance 80 crores is pertaining to the redemption of the shares. So 20 crores will get taxed under IFOS. Balance 80 crores you will do capital gains by taking this 80 crores as full value of consideration, removing your cost of acquisition or index cost of acquisition on the shares. The format is here. If you have any kind of accumulated profits, that we treated as dividends and tax under IFOS. If you have any balance profits, you have to take the money received plus the fair market value of the asset received minus the income treated as dividend. So whatever money you received, 100 crores, in that 20 crores will go to dividends. Balance 80 crores is what you will consider right now. In that 80 crores, you will remove your cost of acquisition or index cost of acquisition in order to arrive at your long-term or short-term gains. Yes. Finally, the last topic, which is called as your firms and AOPs or BOIs. Income tax comes and says, if you decide to give your assets to the firm or AOP or BOI, who are you? You are the partner or the member. If you decide to give your assets to the partner or your assets to the firm or the AOP or the BOI, check what kind of asset are you giving. If you are giving cash, not taxable. If you are giving any personal movable effects, not taxable. If you are giving any capital asset, taxable. taxable. At what value will it be taxable, Rahul? The value at which the firm records the asset in their books. The value at which the firm records their asset in the books. So therefore your full value of consideration will become the value recorded in the books of accounts minus your cost will give you the capital gains. Minus your cost will give you the capital gains. The challenge is the next part. Next part comes and says, if the firm gives you any items, if the firm gives you any items as a capacity of partner or member, as a capacity of a partner or a member, firm can give you multiple items. One is share of profit. One is share of profit. Income tax says share of profit is exempt in the hands of partners. Next, they can give you salaries, bonus, commission. Salaries, bonus, commission, all interest. All these items will be taxable under IFRS. All these not IFRS. All these items will be taxable under PGBP. All these items will be taxable under PGBP, leaving you with the last item, which means any kind of money given to you on reorganization. What? On reorganization, which means there is a reorganization which is supposed to happen in the firm on account of admission, retirement, or change in PSR In that case, income tax comes and says that whatever is the money which I give to the shareholder, along with the assets which I give to the shareholder, minus the capital balance which is showing in the shareholder's account, will be treated as the capital gains taxable in the hands of the partner. Will be treated as a taxable capital gains in the hands of the partner. But the provision comes and says, even though this is capital gains in the hands of the partner, it is deemed to be taxable in the hands of the firm. It is deemed to be taxable in the hands of the firm. So firm will pay tax on this capital gains on behalf of partner. Firm will pay the capital gains on behalf of the partner. The partner will not pay a single rupee tax. Yes. However, if you are deciding to give partner any assets, income tax comes and says, assume that the assets were given to a third party even before the transfer took place. Assume that the assets were given to a third party even before the reconstruction or the reorganization took place, which means whatever is the resulting capital gains will also be taxable in the hands of the firm. And the capital gains or the profit element or the net of taxes, has to be added to the capital balance so that the capital gains is not very high. In simple words, in case you are planning to give any assets to the partner under a reconstitution, step number 1 is to compute tax on that asset separately. And find out the tax. Step number 2, in your books, account for the profit from the sale of the asset minus the tax into partners in their capital profit sharing ratio. Step number 3, now do this mechanism of doing money plus fair market value minus the revised capital balance. Yes, this is how you have to do your capital gains. Income tax comes and says that if you want to apply indexation can be applied on the asset which you transferred. Which means that thing which you did, where you sold the asset independently as a third party valuer, there you can apply indexation. Otherwise, the current mechanism, this method will not be eligible for indexation. The earlier capital gain being transferred as land separately, that will be eligible for indexation, but this will not be eligible for indexation. Next, they are coming and saying that, Rahul, if at all the firm is going to have a capital gain, it needs to decide whether the capital gain will be long term or short term. Income tax said, if at all there is a capital gain coming because of this, then the reason is because there is some other assets in the books. Tell me what are the assets. If I find out that the assets which are there in the books are short term or depreciable or self-generated, then the resultant capital gains will be treated as short-term capital asset. However, if it is found to be an asset which is long-term in nature, it will be called as a long-term capital gains. Rahul, in books I have both split to long-term and short-term. Yes. Next, they are coming and saying that, Rahul, if that capital gains has already been taxed in the hands of the firm, if the capital gains has already been taxed in the hands of the firm, that is only because of the fact that the books has some extra assets. The books has some extra assets. So the profit notional on the books is what has been given to the partner right away. Which means in case there is any gains coming on the firm, if there is any gains coming on the firm, that gains can be allocated to the remaining assets in the books. Only if the gains is coming because of that assets. In simple words, if at all the capital gains is 20 lakhs, that is because the books la irukka asset is also revalued to 20 lakhs, then this 20 lakhs which you have paid excess can be reduced from the full value of consideration when you are making the further sale of that asset. While making the further sale of that asset. So if at all you have any 20 lakhs of gains coming in and it is because of another capital asset sitting in your books, you can reduce this 20 lakhs from that asset's full value of consideration. Please understand that you have to reduce it from the full value of consideration. Do not assume this as a cost of improvement or assume it as a cost of acquisition, because it is not eligible for indexations. It is only a reduction from your full value of considerations.